Case law. New Jersey's case law, as New York's case law, by the way, New York is parallel in that where the taxpayer fails to maintain the proper records, statutory records, then of course, or the records are determined to be unreliable, then that's when the auditor can come in and make an independent determination of what the true tax liability is, CBT and sales. And the two cases which I cite in the slide, Yilmaz, which is for the commissioner, Charlie O's, which when I was at a conference a couple of weeks ago, I won't name her, one of the appellate officers says, well, that decision, I was involved in this. That was an unfortunate decision. I said, yeah, it's unfortunate for the state, okay? It's not unfortunate for the taxpayer, okay? Yilmaz is unfortunate for the taxpayer, but fortunate for the state. So it depends which side of the track you're on as to whether the case is a good case or bad case. But in Yilmaz, and I'll just briefly point out what these cases are about. In Yilmaz both of these are restaurant cases, and Yilmaz, you know what happens? Cases like this should never, ever go to trial or appeal because they make bad law, as Jim knows, right? Bad law, right? And in Yilmaz, taxpayer had no records whatsoever and challenged the assessment because, again, the taxpayer argued that the assessor went too far and should have used more conservative methodology for making the assessment. Well, the court said, well, where there's no records and the court and the auditor selects a audit period, then the auditor can use any reasonable method to make a determination. And the assessment can only be rebutted if the taxpayer is able to show that the assessment, and this is the court's words, far wide of the mark. Now, that's a very fuzzy legal standard, far wide of the mark, but that's what Yilmaz says. Unless you can show that the auditor is off base, not, has no really relevant data whatsoever to make the assessment stands. Now, what happens in real life? Well, what happens in real life is that often taxpayers do not have cash registers tapes, so the tapes are incomplete. Okay, so that's a problem. That's a big problem. The taxpayer fails to maintain proper books and records. I ask my students, I ask them, your client comes to you with a checkbook and check record, banking records. Are those sufficient books and records? I get blank stares sometimes, okay? The answer is of course not. Of course not. A checking account, is evidence, is some evidence of records, but they're not original books of entry. They don't record all transactions. They don't have openings. They don't have closings. They're not auditable in that respect, and so generally they are insufficient to suffice as records. In fact, if you're doing a tax return based on the checking account, that is, on a cash audit, those records will be thrown out completely, and the auditor will make what's called a lifestyle adjustment and bump up gross receipts by, it's called a lifestyle adjustment. That's exactly what they say. And they will look at other indicia, including, as in this one audit I had, they went to the guy's house, looked at his house, looked at how much income tax, property taxes he was paying, said, and it was a rather contentious examination. I said, he says, well, he's committing tax fraud here. I said, listen, this is a sales tax audit. It's not an income tax audit. So there's no reason to talk about other matters. And but they will look at indicia and use that as a basis to make the assessment. So if you don't have cash register tapes, you don't have original books of record, and you fail to maintain summary records, that's your saving grace, having summary records. If you don't have summary records, then you're going to be called the strike factor, okay? 3 strikes, you're out, okay? 3 in baseball lingo, 3 strikes, you're out, and the assessment stands unless you can, there's virtually no way of proving that the auditor is wide of the mark, which is going to result in a very large deficiency for the taxpayer. Now, as you know, when they do these audits, they'll do a test year, and then they'll apply it to usually 4 years, and the tax potentiates, the penalties potentiate, and so does the interest. The statute, the New Jersey statute, as described in the slide, 54-32B19, gives the director wide discretion. In fact, that was brought up yesterday at the examination down in Trenton. Well, the commissioner has wide discretion. Yeah, they have wide discretion, but it's not unlimited. But believe me, it's still very wide, to say the least. What can happen, as I mentioned, yes, it's not only the assessment, and I have another client, they owe $2.7 million in withholding and trust fund and you name it, sales and use, and didn't file tax returns, okay? The failure to file tax returns, come on guys, is 5% per month, cumulative up to 25%. Failure to pay, the underpayment is also includes additional assessments. Plus you have interest, okay? 3% plus the prime rate. Plus you could have fraud. Plus I was at a conference a couple of weeks ago, and I'm told New Jersey now is going to institute they called it a delinquent taxpayer collection penalty. On top of all the other penalties, if there's a chronically delinquent taxpayer, there's going to be another assessment. I think he mentioned daily assessment of $100 a day for for the failure to pay in a timely fashion. So the cash audit is a significant threat to the small business, and as I point out, you need to don't have strike 1, strike 2, strike 3, because your client is going to be out. Okay, thank you.